I'm Callum Mason and I'm the Money and Business Reporter at I. I'm watching inflation, interest rates and mortgage rates on a daily basis, and I think this is what is really important to watch for if you want to know if your mortgage rate is going to come down. So the Bank of England has risen its interest rate, which is the rate which it lends to other banks, 14 times over the past 2 years. So it's gone from 0.1% all the way up to 5.25%, which is a very high rate and means that it costs people a lot of money to borrow on things like their mortgage. There's even speculation that it could go up further in the coming months as well. And the logic behind that is that if inflation is high, you raise the interest rate so that it's more expensive for people to borrow. Because it's more expensive to borrow, they borrow and spend less. And therefore, what happens is that they have less money to spend on things like goods and services. So inflation, the rate of prices increasing, tends to go down. So inflation got above 10% last year, which is a really high level. The Bank of England's target is to get it at 2%. And it has started to come down, but it's still at a high level. It's still at around 6.8% in the figures we got this week. So even though we saw inflation drop, really the figure that a lot of people are saying we've got to look out for is core inflation. So core inflation actually hasn't fallen since last month. What this figure does is it is inflation, but it doesn't include some of the more volatile prices, things like energy and food, which tend to fluctuate. So the core inflation has stayed quite stubborn, and that's what's worrying economists and is the reason why some people are saying that interest rates will have to go up more to sort of tackle this stubborn inflation. One thing that's driving core inflation and stopping it coming down is something called services inflation. This has actually gone up on last month, and that measures things like hospitality costs. What you can end up with when things like services inflation don't come down is you can end up with something called embedded inflation. And that's where there's an expectation in the economy that inflation's going to stay high. And therefore, when workers start asking for their wage increases, they factor in inflation as well. Once you have that, it can be very, very difficult to get inflation down to the target level, which is 2%. So there's a bit of debate between economists on what we need to do next to get core inflation down. There's one school of thought which says core inflation is staying the same. What we're doing at the moment isn't working. We need to up rates further, perhaps by even 0.5 next month, and that'll get the figure down. What others are saying though is that it's not working, so we don't want to keep repeating what we're doing. What we actually need to do is wait for the interest rate rises, which we've done already, to take effect. Some people think this can take 18 months. So that school of thought is that we should pause on rises for now and wait for what we've done to take effect, and then we will see it filter through into the economy and for core inflation to fall. So for now, it seems pretty nailed on that we will have another interest rate rise in September, probably by 0.25 percentage points. Before that comes down, what we're really probably going to need to see is a proper fall in core inflation, and then we might see the Bank of England and the Monetary Policy Committee, which sets rates, say, okay, we're seeing inflation come down. We can now look towards seeing that we've got the peak of rate increases and that we can start to see the rate fall. And that's when we might see mortgage lenders properly reducing their rates.